All right, so on the Money Show, we show that we just don't talk about investing in mutual fund, but also help you meet the brains behind these funds. And in this week's Meet Your Fund Manager segment, we have on board Shridatta Bhandwaldar, Head of Equity, Canara Robeco. And with him, we'll talk about the current market setup, the sectors, his themes he's bullish on, and of course, what should be done in the small cap category. So Shridatta, good evening and welcome to the Money Show. All right, so let's begin with the market movement. How do you read the current market status? Do you see there is near-term consolidation, or you think the party that we are witnessing is about to get over? And specifically talking about mid caps, do you think it's an overvalued space now?
As far as markets are concerned, are they at new high? Yes, of course they are at new high. But one has to step back and think as to why they are at new high and why did not they go to new highs for 18 months or 15, 16 months in between. And the predominant reason for that was effectively the core earnings growth was actually relatively subdued. You experienced a little bit of earnings downgrade for 4 quarter in between for the financial year 23. Uh, and on top of that, you had predominantly the cost of capital, which means the interest rates moving against you between say October of 21 to December of 22. As both these risks are receding and as you are seeing that the earnings are stabilizing, they're not accelerating yet, but as they are stabilizing, and in India earnings are still growing, correct? So in 15 months, while the market has not gone anywhere in between, the earnings have increased by whatever 10, 12, 15%, 10 to 15%. So as the rollover is happening, that's where the new earnings are getting rolled over, and to that extent, market is actually also achieving new highs. So that's the predominant reason why market is coming to new high, because both the earnings downgrade cycle at least seems to have stabilized, and second, basically your cost of capital or interest rate environment seems to be at some point in time over next 9 to 12 months will start turning significantly favorable, and market is a discounting mechanism, so it starts discounting little early. So it's happening not only in India, it has happened in most of the countries, of course, depending on the earnings differential or wherever growth is available, it has happened to a size in a sizable manner. That's first. Second, your question on is broader market looking little overheated or more than overheated? Is it looking like there is a little bit of upfronting of returns that has happened in near term? A possibility in some pockets, but not across the board. Yes, there are pockets where there is a little bit of upfronting of financial year 24 clearly has largely happened. So you will need rollover of financial year 25, probably 6, 8 months down the line for that part of the market to do well. But generically at market level, there are enough pockets in market where even in broad market you're finding enough opportunities. So that's how we would look at it. That's the contextual view. When you take little longer view, and that's what one investor who's little, whether it is retail investor or institutional investor who's going to be keeping money for a year, 2 year, 3 year, 5 year, as you start actually extending the time horizon, uh, and if you actually look at the domestic context today, clearly the domestic context after a very long period between 15 to 20, we struggled with the challenge balance sheets both on corporate side and bank side, uh, while government was doing its bit in terms of reforms, in terms of whatever it could do on the infrastructure side. These two pockets were suffering. We have changed that cycle. You are clearly in a cycle where the corporate balance sheets are extremely clean. Your bank balance sheets are extremely clean. What it means is that you are going to have a reflation of these balance sheets over next 2, 3, 5 years. And as that reflation happens, typically business cycles play out. I'm not saying there are not no external risk or there cannot be external risks that play out intermittently, but at least the enabling factor which are needed for any earning cycle, credit growth cycle, business cycle to play out, those seems to be in place, and that's what makes me far more constructive, irrespective of what has happened in terms of upfronting of a little bit of return over last 3 months. So that's how we are looking at the contextual and more a little more structural part of the perspective on market.
Hmm. Right, got that, Shridatta. So now the other question is the immediate triggers for the market. The next immediate triggers are obviously the Q1 results. So I want to know how excited are you, and specifically, what sectors do you think and what themes do you think have, are overvalued or maybe undervalued, which might be there on your radar also?
Always excited about the quarterly results because it's one kind of snapshot where you get incremental data points. Although sometimes it also creates incremental noise, but you get incremental data points to whether they actually support your theses or they actually break your theses. At least you get incremental data points. You are excited about them. As far as this quarter is concerned, first you have to think what has happened in fourth quarter. So for fourth quarter, uh, thankfully was interesting in a sense that after previous 4 quarters before that, where you were struggling in terms of earnings downgrade, last quarter was the first quarter after 4 quarters where you did not experience any earnings downgrade. At the margin, you had the upgrade downgrade ratio, which is what we call as, which means if I take a BSE 500 and or BSE 200 or BSE top 300 stocks and look at it, how many names outperform the consensus numbers expectations and how many actually underperform, that ratio has started improving. And my hunch is that will continue even in this quarter. And there are not much of a basically debate in terms of which pockets are relatively more resilient in earnings. The financials part of the market continues to be relatively more resilient. NBFCs have started actually participating as the interest rate environment is expected to start turning. Um the auto part of consumer discretionary, uh, hotels, hospitals, telecom, domestic pharma. I think these are the cement. Incrementally, the numbers earnings upgrade cycle uh, seems to be playing out. So these are the spaces where earnings are expected to be either some of them will get upgraded, some or as a basket they will be more resilient. And then you have the other side, which is relatively more externally focused, which is your IT, commodity, and energy, and some of the other exporting sectors, including part of chemicals, where the numbers are expected to be a little more subdued. But it is just, of course, contextual. So uh, that's where the quarterly expectations are as things stand today.
Right, Shraddha, let's talk about the FII flows now. So, obviously, we all know that India is a premium market, and the way we've seen the flows coming. So, despite India being a premium market, there has been money pumping in even at record levels. So, first question: is it the lack of opportunities that the FIIs are facing, and India being the only market for them, makes a very lucrative place to put all the money? And also, do you think this trend has almost peaked out, and we'll also witness a reversal in this trend soon? What do you say?
It's combination of all the things. First of all, the premiums. Yes, India has always traded at a significant premium to other emerging markets. Of course, in near term, that premium has further gone up because you have seen the kind of 10, 12%, 13% move in market over last whatever 3, 4 months, 3 months. But that premium is not devoid of reasons. The premium is predominantly because of the kind of diversified private corporate listed entities that are available in India in a sizable manner, which are very, very capital efficient as a basket as compared to most of the other emerging markets where predominantly they are very, very concentrated markets, generally towards commodities. And that is the reason you trade at a premium. China has its own issues. So even while the premium is going up, that premium going up itself is a function of both the things. You yourself doing well and somebody else actually not doing well, or they getting derated at the margin. That has also contributed over a period of time for that premium to actually sustain at a higher level or go up further. So that's as far as the premium part is concerned, premium valuation is concerned. I think they are here to stay as long as we continue to have superior earnings profile as a country, superior nominal GDP growth rate, and superior earnings growth profile comes with relatively higher ROCs or ROEs as a country. And when I'm saying country, that 150, 200 stocks where predominantly FIs are positioned. As long as that continues, I think the premium is more or less likely to continue. And we're still young economy where probably demographics is extremely good. So we will have this runway for a long period. So that premium might not come under question very, very easily. That's my case. Coming to the second part, whether the FIs will keep pumping in money in near term or not, that's a difficult question to actually handle. How we are looking at it is what they did over last basically 24 months. That gives you a little bit of clue as to what is more likely to happen over next 12 to 24 months, as those fundamental factors in terms of effectively the earnings growth deceleration stops, and at the margin negative, neutral to positive earnings growth plays out over next 2 years, which is on a differential basis will be better than most part of the developed world, at least because those are the guys who are investing predominantly in your country. They are going into either recession or moderation of growth, at least. So your differential of growth profile, which was, if you actually look back uh, 12 months back, 15 months back, or say uh, 24 months back, that growth profile had actually shrunk because of the kind of excess fiscal support that most of those geographies got. As that growth profile actually again turns in your favor, naturally capital should flow towards you. Also, the other enabling factor clearly is your interest rate environment. Declining interest rate environment is generally positive for growth asset classes. So both those factors are likely to, from a next uh, basically 18 to 24 months perspective, are more likely to be positive than negative, like where they were in previous 15 to 18 months. They have sold almost 25 to $30 billion worth of Indian equities during that phase. They have just bought back, I think, 10 or $11 billion or $12 billion as of now over last 3 months. My hunch is that rest of the money over next 24 months, at least, if not earlier, in a homogeneous, heterogeneous manner. It will not be very, very homogeneous the way it has been for last 3 months, but that should come back given that you have differential in terms of growth profile.
All right, that was an elaborate answer. But then let's move on and let's talk about the small caps. Now, for that, do you think any trend reversal expected? We are already overvalued. What is your analysis? And historically, how have they performed as compared to large cap? And what's the way ahead now? Is it the peak out that we might be seeing in this category?
Sure. Generally, we're not believers of holding a lot of cash. Anywhere between 3 to 5% cash is what we maximum hold. So that continues to be there. So that's on cash. As far as uh, how we are looking at this category, I think this is a fairly broad category. There are enough and more opportunities which are present. Again, I mean, circling back to the previous question that you asked, is there a little bit of upfronting or exuberance in terms of how investors are looking at this category? Yes, probably, because of what has happened over last 2 3 years in terms of the returns. I think the category itself has upwards of 30% CAGR. Naturally, a lot of retail investor, a lot of people tend to focus on that number rather than focusing on 3 5 10 year rolling returns. And as that focus has increased, of course there is little more excitement, but at the same time it is important to understand that, as I said earlier also, that if you are going to get into a business cycle, you're going to get into a credit growth cycle, and the intensity might be different depending on how a lot of other factors play out, but at least directionally you are in a business cycle, given that reflation of balance sheets is likely to happen over next 24 to 36 months to 48 months. As that happens, there will be a lot of businesses where the opportunities might get created in broader economy. Uh, so opportunities are present there. That is one. Second is also basically you have a lot of newer sectors, value chains, the supply chain rigid players, manufacturing side businesses, which are emerging in that space, electronic gadget space. As those businesses emerge, probably opportunities uh, are there. Near term, yes, there is a little bit of exuberance in that category, clearly.
All right, so now what investors are supposed to do when it comes to rebalancing their portfolio? Do you think that within equity only, if at all they want to rebalance, it's time to book some profit in mid cap and small cap space, if at all they are witnessing huge amount of money there?
Generally, we're not believers of holding a lot of cash. Anywhere between 3 to 5% cash is what we maximum hold. So that continues to be there. So that's on cash. As far as how we are looking at this category, I think this is a fairly broad category. There are enough and more opportunities which are present. Again, I mean, circling back to the previous question that you asked, is there a little bit of upfronting or exuberance in terms of how investors are looking at this category? Yes, probably, because of what has happened over last 2 3 years in terms of the returns. I think the category itself has upwards of 30% CAGR. Naturally, a lot of retail investor, a lot of people tend to focus on that number rather than focusing on 3 5 10 year rolling returns. And as that focus has increased, of course there is little more excitement, but at the same time it is important to understand that, as I said earlier also, that if you are going to get into a business cycle, you are going to get into a credit growth cycle, and
All right, Shridatta, that will be all for today. Thank you so much for being on the show and helping our viewers as to how can they strategize the investment portfolio moving on. On that note, let's take a quick break, and after that, we will tell you your strategy for your fixed income or for your debt portfolio. We'll be joined by Lakshmi Iyer of Kotak Investment Advisory to guide you through all of this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. We move on now with the benchmarking indices hitting fresh highs in India. The focus in the market has largely been on the equity side. Inflation seems to be under control and chances of further rate hikes look slim. So what does this mean for debt market or fixed income market? Is it time to stay invested in debt? And is worst behind for the markets? Let's analyze all of this with Lakshmi Iyer, CEO, Kotak Investment Advisors. Lakshmi, good evening and welcome to the show. So we are scheduled for a lot of data this week also. The CPI coming in a few days. We also have US inflation data coming in this week, and later this month we'll be having the Fed thing also. But then overall, let's just talk about this month. And a few days back when we were discussing, we were talking about inflation cooling down slightly, but then now looking at tomato and other veggie prices and spices prices, I think the data that's about to come in this week looks slightly high on the food prices side. So do you still believe that the pause in the rate hike will be an ideal situation for RBI, or you think that looking at the expectations and the huger possibility of the data to come out on a higher end also, we can see a slight rise over there?
Hi, Kavita. So I'll tell you clearly, if you look at the food prices, specifically, the tomato, onion, and potato prices, they're actually over the top, largely led by tomato prices, which if you see last month, as in the May over June month, it's almost up close to 40%. And on an aggregate, if you take all these three put together, they're up almost 16 to 17%. Now that means the June inflation number over May, there could be an uptick of at least 30 to 40 basis points. So that's number one. So 4.25 was the number for May, and 4.5 to 4.665 could well be the number for the June. But even after all that, if you see the aggregate April, May, June quarter number could well be at par with RBI's estimate. So that's a positive sign. And much of the spillover, it's not just these vegetable prices, but also some of the pulses, rice, wheat, all of these are up month on month. So the next quarter, which is the July, August, September, is where you could see, some impact of inflation. But is it sufficient enough for RBI to hike interest rates? Well, the answer still seems to be in the negative. We are in for an extended pause. The bond yields obviously have started reflecting this sentiment, and we've started seeing, the yields move up almost 20 to 30, 35 basis points across the curve. So clearly that's what we are, in for. And till such time we see some easing on that front, I think it's very unlikely that you're going to see this extended pause narrative change for now.
All right, so that's on the Indian front or the domestic front. But then, what about US and the kind of commentary also we saw, and also the kind of data that we've seen coming out? A minor rise over there or raise over there in the interest rate that's expected.
Well, yes, if you look at the US 10-year yields, it's breached very meaningfully past the 4% mark on the higher side, currently trading at around 4.07, 4.08. Clearly, again, we look at the something known as the dot plots or the Fed fund futures. What is the amount of pricing in that is happening right now? So even today, as we speak, there is a 0.5%, which is, 50 basis points more of rate hike, which is being buffered into the current levels. So at least one rate hike seems to be in the offing, because there seems to be clearly a tale of two cities or two countries in this matter, where India, there is still a reasonably more docile environment, but rest of the world, including the US, the UK and the Eurozone, the inflation and the overall big picture on the macro front still needs to stabilize, which means we are not yet done with hiking of rates in the US as yet.
So, so Lakshmi, what kind of scenario it is? See, on the equity front, we are seeing markets at all-time high. On the debt front, the bond yields have also factored the kind of possibilities in terms of reports and inflation data, and there has been a minor hike over there. So, if we just talk about debt, do you think this is the last chapter of the entire debt story, as far as this year is concerned, and the interest rate trajectory is concerned? What do you say?
So as I said, Kavita, earlier also, the yields are going to move in a groove. It's a slightly upward moving trajectory, but is that going to be a forever upward moving mark? Well, unlikely. If you look at the 10-year benchmark, which is the bond 10-year benchmark, similar to what we track in Nifty for equities, it's ruling at around 7.15, 7.16. Can there be another maybe 10 basis uptick? Can these yields go closer to the 7-quarter region? The answer is yes. But are we seeing a non-stop? And also we need to keep in mind that there is, supply of bonds, government bonds also coming up in this quarter. It's a reasonably high supply quarter. So, given all that, it's but natural to see some uptick in yields, which was in line with our expectation. But are we seeing a relentless rise in yields? Very, very unlikely, given the fact that this half, or this first half of the financial year, you also see a slightly tepid credit growth on the banking side, and then of course subsequently it picks up. So I think we are in for a range bound kind of a movement. Will 10-year breach 7% meaningfully on the lower side? Well, unless there are rate cut expectations building in with a lag of 2 quarters, that's very unlikely. And again, to breach 7-quarter, we require very strong global uptick in yields. So beyond, say, a 4-quarter on the US 10-year is when we can start seeing significant cracks on Indian bond yields as well. But for now, I think there's reasonable liquidity in the banking system, closer to 1.8 trillion rupees. I think that will keep a reasonable anchor on especially the mid-end of the yield curve.
So looking at this current scenario, Lakshmi, do we still have time to park in money in fixed instrument, at least for the short term?
Yes, absolutely. I think one can continue. In fact, earlier on, we had, suggested that one could look at across the credit spectrum, given that the tolerance or the risk appetite in this kind of an environment for investors in moderate, risk kind of credit also can be taken. I think that view stands. And that is your pursuit of adding on to a little bit higher yield onto the portfolio at a time when the general macro for India Inc. looks to be fairly bright.
All right, that will be all. Thank you so much, Lakshmi, for being on the show. And coming ahead this week, I think, again, we'll be seeing you on the show with all the data outcomes. Thank you.
Thank you.
On that note, we'll take a quick break, but then post that, let's talk about investing in small cap with Feroz Aziz, and also get your mutual fund portfolio queries answered by Feroz after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. The mid and small cap segment has seen phenomenal run-up in the market in recent time, even as the broader end of the market outperforms benchmarks. Two AMCs have halted lump sum investments in their small cap funds. Now, the big question here for you is, should you increase your allocation in mid and small cap, or is it time to sit on cash and wait for the right time to enter the market? Let's analyze all of this with Feroz Aziz, Deputy CEO, Anandati Private Wealth Management. Feroz, good evening and welcome to the show. So clearly we're going to focus on mid cap and small cap, and specifically on small cap, which as per the AMFI data today that's come up has the highest amount of inflows also. But then just talking about the market in general, market so far has given almost 13.2% return in what, almost 3 months from now. But then is there more upside possible? Also talking about small cap space, in 5 years it has doubled. So what is your research report and what is the data that you've accumulated trying to translate this movement of small caps into?
Hi, Kavita. Good evening. So point one, like you said, the market has delivered some return, 13%. Some is an understatement. But having said which, it went into a time correction mode for a year and a half from October 2021 till the March lows. So this financial year has been good as expected. Of course, when people lose hope that market will give return is when it starts giving return. When the last man standing has become pessimistic, which is what I was seeing in March. And your show, I also said that March lows were very good entry points. A 1.5 year time correction could have been capitalized upon, and several of the Indian investors have capitalized, especially the lower strata of India through the SIP mode has capitalized on this rally. Point one. Point two, can something like this continue? To my mind, if you look at the answer for this, if you look at the right variables, if you look at variables which is corporate earnings from a 3 to 5 year perspective are going to dictate where the market is headed. From a long-term perspective, which is 8-10 years, the macroeconomic environment these corporates operate in will dictate where the market is going. So if you're looking at 3 to 5 years, corporate earnings becomes the most important variable. According to us, we place a lot of emphasis. So 820 rupees of Nifty earnings is reason enough for the markets to have done well, and they've done well. So we're looking at 920 to 940 kind of earnings for this year, which may happen. As we go along, we would get to know. So there is not too much of an upside potential with the earnings of 930. If there is some pleasant surprise on the earnings side, there could be more than 10% upside for this financial year from here as well. But 8 to 10% fundamentally looks fair. Coming to your second question, small cap, like you said, has got a lot of inflows, but there's a great news for each of us and take pride of, because this is the first time in my 18 years of career I'm seeing retail is buying underperformance. Small caps have underperformed. The small cap index has underperformed the Nifty by about 4% for 5 years cumulatively. And in spite of that, there is inflow. Of course, funds have done well from a compounded basis because 71% of the funds in the small cap space have beaten their own respective benchmarks.
Exactly, but then let's deep dive slightly in the data also, Feroz, because historically what the data shows is as compared to large caps, how well or in what periods have small caps outperformed and underperformed, and based on that data, where do you think the trajectory is headed now, maybe for a couple of more years, near term maybe?
Yes, Kavita, before I come to that one specific question which you raised, which is a very, very important question, I would like to tell each viewer that there's one mathematical anomaly. When people look at mid caps and small caps synonymously, I think it's a very wrong thing to do, but it's so popular. When they leave large cap, they speak mid cap and small caps in one breath, which I think mathematically doesn't hold true, because mid cap is a 150 stock segment from a mutual fund investor standpoint. And the rest of the full big tail is small cap and small cap, or micro cap as people call it. So coming to the most important question which you asked, the small cap segment, to my mind, has a potential because the earnings growth for this financial year, as per us, is projected at 20% for the small cap index, 250 index, which I think is far healthier. And we're looking at about 12 to 14% earnings growth for Nifty and only 12% for mid caps. So this is the first time it's happening that mid cap is not as attractive large cap is attractive, and the other segment, which is a small cap, is attractive. Leaving these 150 stocks, which we think that the earnings growth could be muted. And is it a good time to add small cap? Yes, because if you look at the froth, which is mathematically computed at Anand Rathi Wealth, is minus 39% for small cap. So fundamentally, the small cap should quote at fundamentally. Fundamental doesn't hold good at all points in time. But still, fundamentally on paper, there's a 39% potential for it to become fair valued, and Nifty currently is already fair valued. So the headroom is there, but the patience is going to be the most important virtue for a small cap investor.
So, Feroz, now taking this data under consideration, why are we seeing funds restricting inflow? You know, two of these small cap funds, Tata Small Cap and Nippon India Small Cap, which is also the largest small cap fund, they have restricted or they have stopped their lump sum investments for now. Why this kind of a call, and what does this mean for an investor?
Kavita, see, what happens is, if you go into the fund manager's shoe, he's identifying ideas to deploy money. But investors are going to wait. So investors sometimes pump in large amounts of money in small pockets of time. And that's what has happened with small cap. So the fund manager is right in saying that slow down, investors, I'm going to halt it momentarily so that my research team can identify opportunities which do justice to investors' money. So I think because of the sporadic nature of inflows in the mutual fund platform, because anywhere sitting in any part of the country, on a click of a button can add monies, but the research team has to do justice to that money. So you're better off not taking the money than taking it and underutilizing or suboptimally utilizing that fund. But to my mind, if research is done well, and we are the largest listed number of stocks in the world on BSE and NSE put together, so that makes it a very, very lucrative space to be able to identify those opportunities. I'm sure the research teams are working and burning some midnight oil to be able to absorb this demand of small cap investing, which has emerged over the last few months.
So, what are the small cap funds that you are recommending? And the route of investment is obviously through SIP. So, what are your funds recommendation in small cap?
Small cap, not from a past performance standpoint, but it had a fund manager change about a year and a quarter back, and there is a lot of rejig which is happening, and all the decisions which have happened in that fund, we have analyzed each decision for its merit. And I think ABSL Small Cap is a great fund, and it's been a part of our model portfolio for a few months. HDFC Small Cap, Chirag Setalvat's fund, which is, to my mind, the largest fund, and still done justice, irrespective of the size, which I think is just beautiful. They have about 17 stocks less than 5,000 crores of market cap, which I think requires far more effort, and that's been done. Invesco India Multicap, Tahir Badshah personally looks at this portfolio, who's the CIO of Invesco as well. So these are the small cap. But there are two words of caution. When you look at small cap as an index, people generally believe that index fund is lower at risk in terms of investing. In small cap, is just the opposite. If you buy yourself a small cap index, you are taking more risk, because there will be some stocks which don't fit the bill from a governance standpoint or any other parameter. The fund manager's job in the small cap space is not to just spin off returns and alphas, but is to manage the beta, which is nothing but a risk measure. I met a client who was a very large client. He says, I'll do index investing in small cap because I want lower risk. But risk can be only analyzed in 250 stocks if a fund manager is eliminating those questionable stocks, which should not be a part of your portfolio. So that's the most important word of caution. That's why 3 funds with 3 different skill sets is what I would put on the table for one's consideration in the small cap space.
One last question on this topic, Feroz, and then we move on to our viewers who are waiting for their questions to be answered. Since we are talking about small cap, there's a lot of buzz about micro caps also going on, investors going gaga over it. We've also seen funds being launched. One word of caution for this particular category.
See, we analyzed the extent of mutual fund holding in the micro cap. If I define micro cap as less than 3,000 crore market cap, which is small. So they're under-researched. They're going to be driven by demand and supply. And there is going to be very large impact cost. When you buy something, you raise the price. The next day you sell something, you yourself bring down the price. If there are so many micro caps who have volumes less than 2, 3, 4 crores Indian rupees per day. So anybody who decides to buy 2 crores of stock is going to move the price up by 2%. And the next day he sells it, he might move it down by 2%. So you have to be very cautious of the impact cost on low volume stocks, which is what a 3,000 crore market cap is going to deliver. So under research and low volumes can be very detrimental. If the market takes a sharp turn, then the dents could be far larger, because if anybody comes to sell, then he's going to bring down the price by 10%. So you have to be not venturing into something like this. Personally, as an investor directly, for sure. And I think one thing which comes to my mind, small caps itself today are very large. The biggest small cap as per the market cap of AMCs or SEBI's definition is 16,500 crores of market cap. Now that's not small cap in any stretch of imagination. 5 years back, the largest small cap was only 8,000 crore market cap. But they're still in the English nomenclature called small caps, but the value in terms of market cap has doubled. So you're not taking as much risk as much as perceived to be when you're going into small caps, but micro caps still remain far more riskier on 2 counts of illiquidity and under-researched.
All right. We move on, and we also have a viewer online with us. We have Arvind Raj. Arvind, hi, good evening. How are you doing today?
Hello?
Hi, Arvind.
Yes, yes.
Okay, so we are taking... Great. So, what is the investment amount that you are planning?
Investment amount. I have planning for invest monthly 5K around. Okay. I would like to invest in SIP funds.
Sure.
SIP
sure.
funds. Okay. And just now I have invested in ICICI Prudential Mutual Fund. This is a mid-cap mutual fund. And one other is also mid-cap Mirai asset. It's showing that it's still not going up, and sometimes going up, sometimes going down. And I'm planning to invest in 10 years. Could you suggest me what is the correct fund I would like to invest?
Sure. Okay. All right. So 2 crores in 10 years, and you can invest 5,000. So far, what's the SIP amount going in these 2 funds?
Initial amount.
What is the SIP amount in the mid-cap funds that you're doing right now?
I'm doing right now in ICICI Prudential. I am investing 3K. And Mirai Asset Mid-Cap Fund, I'm investing around 2K right now.
Okay. So far 5,000, and you are ready to invest more 5,000, right? So in all 10,000 SIP every month. Got it? Right? That's right? Okay.
Yeah.
Perfect. Okay. Feroz?
Yes,
Feroz?
Yes, Kavita. Kavita, in my opinion, before I get to Arvind's pointed question, I think there is most often than not, when an investor gets disappointed with his investments, it's largely because of unfair expectations or not right expectations. See, when a mutual fund investor is investing in a mutual fund, his expectations have to be very fair. Getting to 2 crores, kind of a corpus needs 25% IRR, and that's not so easily possible. If that was possible, Warren Buffett wouldn't be so popular with 22, 23 for long periods of time. So point I'm trying to make is have a fair expectation of 14%. If compare it with if you did an RD, where would you get? And try and compare that and not expect a moon from mutual funds. If this one point is internalized, you will be using mutual funds for the right reasons and never be dissatisfied. Second point, like Arvind says, it goes up sometimes, it goes down sometimes. That's what you should expect. So that's no surprise, Arvind. That's how equity markets behave. That's the reason why you're getting 2 times more than an FD return. Why should somebody get 2-3 times more than an FD return? Is because he or she is able to put up with that pain in the short term, so that the long term is very, very fruitful. Having said which, for you to get to 2 crores at 14% in 10 years, the SIP amount needed will be 77,000 rupees. Either you expand your time frame. If you expand your time frame to 30 years, for example, then with 10,000, even lesser amounts, you can get to far more than 2 crores. So that's point 3. Point 4, I'll give you some funds which you can invest or consider to invest. DSP Equity Opportunities, Franklin India Blue Chip, HDFC Flexi Cap, and you can also look at the other funds from a HDFC basket itself, HDFC Small Cap, ICICI Approved Dividend Yield, ICICI Focused Equity, Invesco India Small Cap, Kotak Emerging, Kotak Multicap, SBI Contra. The reason, Arvind, I'm reading out a laundry list of these funds is if you have to achieve a holistic objective, you will need 10 funds. So if you have 10,000 rupees to invest, you can maybe start with splitting 1,000 rupees in each of them, and you can keep doubling up as your amounts double, and you are able to afford more SIPs. And all the best, Arvind.
Best, Arvind. We move on, and Feroz, we will take Garima's question now. This question is via email, and she wants to have a corpus of 5 crores in 7 years. And for that, she wants to understand what kind of a fund mix is needed and what's the amount of SIP that she can go for. She's just invested in Parag Parikh Flexi Cap, and that's the amount is 7,000, and that's for 5 years. She just started this 2 months back, and the goal so far is just a retirement goal. I don't have her on the phone line, so that's it in terms of details that we have. Feroz.
Thank you, Kavita, to read out the details for me. Garima, if you're listening to us, again, I would like to reiterate the expectation. See, if 7 years is not a great time frame for a mutual fund investing and compounding to kick in, these crores happen only if you invest for those 20, 30 years. For a 7-year corpus, even at 14%, which is, I think, a good quality return because FDs post-tax get you about 5.5%. 14% is still 2.5, 3 times your FD return. Even at that, you will need a 3,54,000 SIP to get to that corpus of 5 crores in 7 years. And you're starting with 7,000. So the headroom, the gap is enormous. So you will have to look at your retirement corpus to wait for a little longer. Of course, I think you've done a great job in terms of estimating your retirement corpus to be a 5 crore amount, which I think is a reasonable amount. So I'll still read out the funds for you. Try and scale up as much as you can. Second thing is try and expand the time frame, because the time frames of your goals are the most flexible variable which you have. So if you're thinking 7 years, try and see if I can make it 12 years, 14 years, so that it becomes a realistic goal with the current incomes and the disposable incomes. So the schemes, I would repeat almost the same ones which we read out to Arvind. DSP Equity Opportunities, Franklin India Blue Chip, HDFC Flexi Cap, HDFC Small Cap, ICICI Approved Dividend Yield, ICICI Focused Equity, Invesco India Multicap, Kotak Emerging Equity, Kotak Multicap, and SBI Contra. These are 10 schemes. Of course, Parag Parikh Flexi Cap is there. You can continue with that. And at a point in time, you can probably converge this to the same 10 schemes in about a year's time when you're free from your exit load period on the current SIP of 7,000.
All right, on that note, it's a wrap. Thank you so much, Feroz, for being on the show and helping our viewers with their strategy in small cap and their portfolio-related questions. Thank you so much. On that note, it's time to sign off, but I'm going to leave you with our WhatsApp number and our email ID where you can reach us and send us your mutual fund portfolio-related queries. Thank you so much for watching. Goodbye.